Hey guys, and welcome back to the channel. My name is Rebecca Young from 5 to 9 Real Estate. And in today's video, I'll be covering off how I use cash flow and appreciation in my analyses to help me determine if a particular property is a good investment. Now, a question that I typically get from clients when I do the same analysis for them is, how did you come up with that specific rate for appreciation? So I use a very conservative 4% typically, depending on the area and the economy, what's going on within that year. But I also wanted to show you guys leveraging actual data and graphics to help illustrate why I chose that specific number. And I'll actually be flipping over to my laptop to walk through that example to show you. So if this is of value to you, and if you'd like to see more content like this, please go ahead and like the video, subscribe to the channel, and please, if there's anything else that you'd like me to cover, any other questions you have or ideas for future videos, please leave me some comments below. I take them into consideration for future videos as well, and I really appreciate the engagement on the channel. With that, I'm gonna pop over to my laptop now and actually walk through a couple of examples for you guys. Okay, so this is the home price index, and this data is supplied by TerraNet, and it looks like they have a partnership with the National Bank of Canada. Honestly, I just wanted to use this graphic today because I love how they laid out the data like this. Saves me the time of building this out myself. So thank you, TerraNet and National Bank of Canada, for that. So this chart is based in Hamilton, looking at yearly data. And on the left-hand side here, we've got the 12-month percentage change. So this is partially what I'm going to be talking about and the reason why I choose the appreciation rate that I do. And then on the right-hand side, we have the home price index. The home price index is essentially a benchmark index looking at a specific type of property to help us determine, essentially to determine how prices are changing over time. So for the purposes of today and for the purposes of looking at this data and what it means when we're analyzing real estate, I want you to think of this 12-month year-over-year percentage change as exactly that, the comparison of, looking at January 2011 compared to how that changed to January 2012. And that basically is just captured over time. It does capture by month, but it's year-over-year data. And then on the right-hand side, honestly, it's a bit of an oversimplification, but let's just think of this as this trend line is basically the average price of a specific type of property across Hamilton. And for this specific HPI, it's very likely the composite HPI, which is basically just an amalgamation of these different types of properties. So basically, when I look at this data and how it's changing over time, the reason why I use 4% is because that's incredibly conservative. It's usually just a little bit over inflation, but then that makes people happy because it captures any volatility that could be captured in the future in the term that you own the property. So if I look at the left-hand side here, the 12-month percentage change, it's typically hovering between 0 to 10%. And then you have some crazy years where it's dipped a bit, and then some crazy years where it's jumped up to 25% year over year. But just keep in mind that this doesn't mean that it's always growing at that amount. It's not the same as how it's increasing the average price. And the reason why I think it's really important to actually dive into these numbers and show you what's happening here is because when I talk to people that might be a little bit nervous about real estate and, thinking in the shoes of my clients as well, when they're thinking about investing in real estate, and one of these perceived risks is, well, what happens if you buy in a bubble, right? So if I use a data point here as an example, let's just say June 2017 in this case, a lot of the naysayers will say, well, if you buy at the top of this bubble, when you go down this trend line, it looks like it dipped to, it's fallen by 25% to July 2018. And this prevents a lot of people from actually pulling the trigger to get into the market. And there's merit to this. And so, I promised in this video that I would talk about potential risks and how to mitigate against that. The biggest thing that I would say is that you don't want to be in a position where you have to sell during that period. It's the same thing if you're looking at the stock market as well, that people panic when the stocks start to decrease in value and they sell, and that's when you actually realize a loss. So how can you mitigate for these risks? Well, I always say to clients that, and I practice this myself, the first thing, especially when you're starting out, is that you want to make sure that you have appropriate reserves on hand. I typically recommend 3 months of all of your expenses for the property, and I'll do an example later in one of the videos on the channel as well, but that'll help you determine approximately how much money you need to have for that reserve. Based on what's happened this year with COVID, I'm probably going to recommend bumping that up to 6%, especially if you're a little more risk averse and you don't want to be in a position where you have to sell in this case. The other thing that you can do is you really want to try to find a property that cash flows. And if you have a property that's, still producing you, let's say about $500 a month in monthly cash flow, then it doesn't make sense that you would sell during this period, because regardless of what the property value is, you have an asset that's still producing income for you. So why would you sell it during that time? And the biggest point that I wanted to make here is that ultimately real estate is a long-term game. If anybody tells you that, you can get rich quick in real estate, or they've got strategies that turn around properties quick, I would really do your research into that, because I don't trust that personally. It doesn't make any sense. Slow and steady has been reliable for me. Analyzing properties, understanding what to expect has been reliable and has generated wealth over a longer period of time and continues to do so. So it's just something to keep in mind when you're looking at these numbers as well. And again, coming back to the reason why you want cash flow is because it's going to help you, it's producing income for you, and that's reliable. So the other thing that I wanted to cover off for you guys is that I wanted to actually use an example from one of my own properties. And for this particular property, I actually purchased it in 2011, December 2011. So December 2011 right here. And I bought this property in Stony Creek, which is a community in Hamilton, basically. And I bought it for $251,000. And so unfortunately, I was in a position where I actually had to sell in 2018. I actually owned this property with my ex, and we were separating. So we divided our portfolio and had to sell some properties. And the reason why I tell you this is because during this time, when we look at this data, I was selling during the time that the foreign buyer's tax was introduced, and we did see a dip in the market. So I was selling during the period that I would normally tell people that you want to try to hold on to the property. And this was during the time that you were reading the headlines in the newspapers and everybody was focusing on this dip on this blue line, right? And so you would think that based on this information or the way that it's being spun in the media, that I would have lost money on the property. But the reality is, when we look back over at the black line or the home price index, I bought in 2011, and then I rode this appreciation until 2018. So despite I took a bit of a hit, I took this dip basically when we had to sell this property, I still sold it. In that case, I actually had an offer from a buyer for $470 for the property, but in that case, it was easier. We just ended up kind of dividing the portfolio. So I actually sold this property to my ex for $455. But the point being is that I grew my money by $254,000. And the thing is that people get so afraid of this dip here, but what happens is that over the long term, the property values are still going up. So as long as you are holding on to properties for the long term and you are buying them for the right reasons, you protect yourself and you actually have a really sound investment. So I just wanted to help illustrate with this graphic here as well, to help illustrate the point of these principles and to help you feel more confident when you're making these decisions. So thank you again for tuning in, everybody. Hopefully you found this to be of value. Like I mentioned before, if you guys have any further comments, I would love to see them below the video, any ideas you have for future videos as well. And really appreciate the engagement as always. And don't forget to subscribe to the channel and like the video as well. All right, until next time, guys, thank you and take care.